We're going to go ahead and get started. First, this has been sitting up here for a while, so I hope you all read it. That's the disclaimer. But while you're reading it, let me ask you this. If I said I had an opportunity for you to invest $500 this month, and at the end of the year make $3,000, I'll give you $3,000 back. How many would do that? Yeah, pretty easy. What math heads? What return is that?
600%.
600% return on your money. Good. Later tonight, I'm going to give you an opportunity to invest $500 and make a $3,000 return in 12 months. And I'll tell you that a little bit later. Okay, tonight's class is real estate as a business. Okay, we're going to talk about sort of the business side of being in real estate. How many are agents? 1, 2, 3, 4. 4 agents. Okay. Being an agent is one way to make money in real estate. Okay, you can represent buyers and sellers and make a commission. There's a lot of other ways to make money in real estate, and that's what we're going to talk about tonight. We talked about retail agents and brokers. Okay, there's 4 of you in here. That is one way to make money in real estate. Property management. How many of you real estate agents property manage for others? Anyone? Just Trevor? Okay. Title insurance, mortgages, appraisers, contractors. These are sort of like affiliates of real estate. Okay. Title insurance. We've got someone with title insurance here. Okay. Anyone do mortgages? Nope. Appraisers or contractors? Inspectors. Bird dogging and wholesaling. We're going to talk about a little bit about that tonight and what those terms mean and a little bit about them. Has anyone bird dogged a property? Trevor? Who does not know what bird dogging is? And it's okay. Just name. Wholesaling. Okay, another way to make money in real estate. I'm assuming everyone knows what wholesaling is. Flipping properties, of course, holding rentals, and landlording. This is actually, when I say landlord, I mean managing the property for yourself, as opposed to property management for others. And partnering in real estate. Okay. The first 50 minutes or so of the class is actually for real estate agents. They're getting CE credit tonight, so congratulations to them. Okay, it's always nice to get CE credit. So the first, we're going to start off talking mostly about real estate agents, but a lot of this really applies to just about all of you, regardless of what you're doing. Okay, we're going to talk some very basic principles about employees. We're going to start off talking about employees and independent contractors. If you're a real estate agent, Deanna, are you an employee of your broker, or are you an independent contractor of your broker? You're an independent contractor. Why do you say you're an independent contractor? Because they pay you $10.99? Okay. Any other agents in here that might have a different take on that?
We're kind of both.
You're kind of both?
Yeah, because we have to operate under the direction of a broker. We don't have our own business license and our own setup, so we have to be affiliated with the broker as a sales agent.
Right.
But at the same time, we do our taxes 1099 like an independent contractor. Those
Yes.
of us who haven't set it up as an S corp or something different yet.
Right. Real estate agents are actually a bit of a combination of employee and independent contractor. Okay, they're kind of they're a hybrid. But if you are in real estate, you might hire independent contractors. Hire an independent contractor to rehab your house. Okay. What if you have a contractor, you found a really good contractor, okay, and you use this contractor over and over and over and over again. You start doing lots of flips, and this contractor ends up working exclusively for you. Okay. That independent contractor may become actually an employee. Even though you continue to pay him $10.99 and call him an independent contractor, he actually may be an employee. There's no one thing that determines who's an employee versus who's an independent contractor. Okay? If it's ever challenged, when might this be challenged? Well, let's say that someone is working for you and they're on a job and they slip and fall and they get injured. Okay? They want to sue you, their employer, right? Okay? Well, as the employer, what do you want to call them? You want to say that they're an independent contractor. Okay? So you're going to have a battle. Okay? And you're both going to go to court and you're both going to present evidence to prove whether or not this person is an independent contractor or an employee. Okay? So these are the things the court would look at. So let's use real estate agents as an example. They're paid $10.99. Okay, that's on the independent contractor column. Okay, do agents invoice their employer? No, typically they do not invoice. They just close a transaction, they get paid their commission. So they kind of look like an employee. Are they paid on a regular schedule or the termination of service? Termination of service. When you do a closing, you get paid. You don't get paid twice a month or once a month. You just get paid at closing. So now they look like an independent contractor. Works with one employer. Yeah, typically agents hang their license at one brokerage. Autonomy in work assignments. This means no autonomy means they are pretty much at the direction of their boss. They do what their boss tells them. Autonomous means they're making their own decisions in how they proceed in their work. Agents generally are autonomous. Okay? They decide how much work they want. They don't want to work that week, they don't work. If they want to hustle and go get a lot of clients, then they control that. Control over the details of the job. Typically, agents control most of what they do as far as generating revenue. There are a lot of rules, though, that the brokerage and your licensing will dictate. So you are kind of, how you do things is pretty much dictated to you. You have no direct supervisor, but you do have a supervisor, your broker, right? Because your broker actually signs off on everything that you do. So they do supervise your work. That's why you hang your license at a brokerage. You're not authorized to do it on your own. You have to have a supervisor. You pretty much usually use your own equipment, but there are agents, there are brokerages that provide absolutely nothing to their agents, right? It's just a place to hang your license. Others will provide you an office and printing and assistants and clerical and all that other kind of stuff. Generally, agents work under an independent contractor contract. They're just sort of hired while they're hired. They can quit at any time, and they're being paid 1099. It's generally short term. Skill, well, that depends on the agent, I suppose, but every agent in this room has a great level of skill. Okay? And in fact, there are agents who probably know more about real estate than their brokers do. And they could be brokers because they've been in the business for 25 years. They know everything. They just choose not to be a broker. So they actually may have more skill than their employer. They just simply choose to work for somebody else. Insurance. Typically here, most real estate agents are not self-insured. Your E&O insurance goes through your broker. Okay? So you see that a real estate agent kind of falls in the middle here. Most likely you're going to be deemed, though, an employee, okay, for real estate agents. But regardless of what you do in real estate, whether you're hiring an assistant, you're hiring somebody to go look for properties for you, or to do marketing for you, to manage your properties, etc., remember this, because this will come up. We'll talk a little bit more about why this is important a little later, but this is very, very important when working with others in real estate, because real estate's a very interesting industry. It's very ambiguous, and there's not a lot of rules with real estate investing. Okay, it's sort of much, just go out and do what you do. And so the education is to learn things so you don't get into trouble. Agency. Okay. Does anyone know what agency is? The agents probably know because you've had coursework. You've had to take classes and get licensed. What is agency? Anybody know? Trev?
What is agency?
Yeah. From a legal standpoint of, yeah, do you know?
It just
do you remember from your classes?
You're authorized to act in the name of someone else.
That's right. You're authorized to act in the name of somebody else, and that somebody else is liable for what you do. Okay? It's a legal term called respondeat superior. It's Latin. But in other words, it means your superior will respond on your behalf. They're going to take over your liability. As agents, you've got two sets of agency, one to your clients and one to your broker. Okay? To your clients, what are some of your agents? Another legal term is called fiduciary responsibilities. You may have heard that term. A fiduciary responsibility is sort of a duty or an obligation that you owe simply by working for this other person. Okay? What are some of your duties to your clients, agents?
Look out for their best interest.
Look out for their best interest.
Confidentiality.
honesty, loyalty, okay, no cross-dealing, okay. To your broker, pretty much the same things, okay. Here is what we call scope of employment in agency. And we said that if you are doing something on behalf of your employer, then your employer is liable for your acts. So if you do something wrong and you are sued, your employer will pay whatever damages there are because they're responsible for you. But they're only going to pay those damages if you are acting in the scope of your employment. For acts that are in furtherance of the duties owed to an employer, the employer is liable. If you're an agent and you have a client in your car and you get into a car accident, who's liable? The agent. Why? You're being a real estate agent, you're showing your client a property, you're working for your boss because your boss is going to make money on this transaction. Why is the agent liable?
Because driving the car is not directly related to selling a house.
I don't have to drive the car, but not driving a car with the client in the car is not directly relatable to. Yes. Which is why all agents, what do we tell all agents? Do not put clients in your cars. Okay? If you're in an accident, your employer is not going to cover you. You are personally liable for that. Okay? And there's a way to protect yourself. We're going to talk about that tonight. Okay? Because agents, again, are unique. Some of their business acts are covered and others aren't. Okay? So I want you to be aware if you're an agent. Are you an agent by chance?
Yeah.
Yes. Oh, we got another agent. Good. What's your name?
Jesus.
Jesus. Nice to meet you, Jesus. Okay? So yes, agents are in this unique situation. If you were a true employee, then pretty much everything you do is covered as long as you're acting within your duties. You know, as long as you're not committing fraud, you're not lying, you're not cheating, you're not stealing, okay, you're not committing some, hit somebody over the head with a 2x4, that sort of thing. Anything you do within the course of your work is going to be covered by your employer. With an agent, that's not necessarily true because you are kind of in this gray area. Two kinds of liability. Personal liability, okay? This is a liability that attaches to you as an individual, you as a person, and it attaches to all your personal assets. Easiest way to explain this through an example. Okay, I got a little guy in a car joyriding, right? Personal liability would be if you're in your car, you're speeding down I-15, you're drunk, you're on your cell phone, you're swerving lanes, and you run into a bus full of kids, and all the kids die. Sorry to be dramatic, but let's be serious. Okay? Don't drink and drive. Don't. Okay? Now, if you're doing that, who's at fault? You are, right? You were being boneheaded, and you got into an accident. You caused somebody else damage, right? You hurt somebody. Then you are personally responsible to repair that damage. Okay? In court, that means you're going to pay money. That's what it means. Okay? If you are personally liable for something, the court can attach any of your personal assets. What are your personal assets? Your personal home, your personal savings account, your personal car, jewelry, furs, artwork. It can attach your wages. If you're a real estate agent, it can attach future commissions, okay, because you're personally liable. Professional liability. This is liability that you incur when you are acting within a profession. For example, if you are a landlord, okay, we're going to teach it by example. This is a guy slipping and falling. Okay, this is the slip and fall in your business. So you are a landlord. You own a rental property. You've got tenants. And your tenants called and said, hey, the railing on the stairs is loose. Can you please come fix it? And you don't go fix it. Someone's walking down the stairs, the grandma, she starts to fall, she grabs onto the railing, it pulls off from the wall, she falls down and breaks her neck and is paralyzed. Okay? You were acting in that case as a negligent landlord. Okay? That was your profession, that's your business. You are a landlord. Okay? Then they are going to sue the company. Okay? So they're going to sue the LLC, we'll talk about this a little bit later, but they're going to sue the LLC that owns that property or the property management company that failed to repair the the hand railing. Okay? So in this case, if they win, if this grandma that is now paralyzed wins in court, and they sue the company, the only assets that they can get to are assets of the company, which might mean the property itself, the house that they were in. But they can't touch your savings account, or they can't garnish your wages. They can't get your personal home or your personal jewelry or your personal stock portfolio, okay? Because all of this is maintained within the business. It's business liability, and the business is responsible. Personal liability is the person is responsible. Okay? So two very separate kinds of liability. I teach actually a 2-hour course just on this. Okay? In fact, it's going to be down in Utah County on March 15th. It's called my corporate superclass, and you're all welcome to attend. Yes?
Are we allowed to ask a question?
Yes, absolutely, please.
Sorry. So Jeff, if that happens, our personal umbrella policy also would not cover us if they sue the LLC. Is that correct? Or is there a way to
Depends.
get that?
The question is, if you're a landlord and you have this rental property and you also have what's called a personal umbrella policy, okay, which is an insurance policy that's kind of added onto your other insurance policies. You can get umbrella policies that add on to your landlord's insurance. But you got to make sure you have the right umbrella policy that will cover this. So check with your insurance agent that it will cover that it's an add-on to your landlord's policies as well.
So would that be in the name of the LLC, or would that be personal in my own name?
It's going to be a personal. You're going to have a personal umbrella policy, but it's a rider or it's an add-on to other insurances. And you just got to make sure that it adds on to the insurances that you wanted it to add on to. And most umbrella policies, if you get with the right agent, will get you that, because this is very common for landlords.
So a landlord's policy in general isn't going to cover something like this?
It will, but it's capped, right? You have a limit. You have usually it's either $250,000 or a $500,000 liability limit. That's when they talk about your liability maxes, and they do you want $500,000 in liability or $250,000 in liability? That's what they're talking about. Yeah. That if the judgment's $1 million, your insurance will pay $500,000 of it. You or the company is responsible for the rest. Yeah. And if the company doesn't have it, then they're going to sue anything that company owns, which means they're going to take away the house and sell it to pay off the judgment. But as long as you've got an LLC, we'll talk about this later tonight, that kind of contains that, then that LLC will just file for bankruptcy, and that you'll lose that house, but everything else is protected. Up here and then in the back.
Are there restrictions to liability, meaning that as I walk around my property, I think somebody could come in and sue me for just about anything that happens on there? There's some common sense restrictions.
I'm probably thinking more limitations.
Limitations,
yeah.
Yes.
It's called. There are definitely theories in the law called contributory negligence, is what it's called in the law, which means if the person that slips and falls, if they were running across the yard and fell, and you could prove that they were running, well, they would contribute to their own damages. So there are things, what are called defenses to liability. So if you're sued, your attorney will go through all of those defenses, and then if you're still liable, then they'll say, well, the plaintiff was also contributory in his own injuries, and the court would say, okay, the landlord's responsible for 80% of the injury, and the plaintiff's responsible for 20% of the injury, and then you're responsible for, and then they say it's $1 million judgment, then they'll award the plaintiff $800,000 because you were only 80% liable. So yeah, there are mitigating factors and things like that, yes. Here's a big note. So now that you kind of know the two kinds of liability, this professional liability, the landlord slip and fall example, can become personal liability, okay, if you are your business, okay? Because if you have no entity formed, you as an individual, you're the landlord. Your personal name owns the house, and your personal name is the property manager. So who is the tenant going to sue? You personally. And if he sues you personally, then any of your personal assets can be attached in the judgment. You can lose your savings account, your personal car, your personal house, etc. Okay?
So is the way to just quit claim it from your name over to the
LLC.
LLC.
Warranty deed it, but yes.
Warranty deed.
Yes, you're going to transfer title, and all your contracts will be in the name of the LLC. And I actually teach that corporate superclass. We'll talk about that. Because the second part is, once you set up that LLC and you transfer title, then you've got to manage that business correctly. And that's really what we're talking about tonight, is the business side of things, so that you run your business correctly to maintain the protection you wanted when you first set it up. Okay?
Jeff?
Yes.
If you had a property manager and they were majority working for you, and that slip and fall, can they get through the property manager to you?
Yeah, the question is, if you hire a property manager, okay? This is I actually use this in my asset protection classes. We talk about how to sort of spread and divert liability onto other people, okay? If you are a landlord, you hire a true third property management company. I know TPM down in Utah County is real big. I don't know who the big ones up here are, but you hire them. I've seen their contracts. Their contracts state, we are not liable for anything, period. They're not going to hold up in court. I don't like this. Every time clients come to me with those, I'm like, no. But pretty much all property management companies make you sign those agreements. But they still, even with that, if they are negligent in their management of the property, yes, if you're sued as the owner, you're going to join your property management company and say they were the ones responsible for fixing the handrailing and failed to do it, and they are responsible. And a court will kind of look at everything and sort it all out. Now, I have a lot of clients who will own rentals in their LLCs, and then they will set up a separate property management company that owns nothing. But it manages all those properties, and that property management company, by contract, takes on liability for doing all the repairs. So if they are sued, then the landowner, the investor, let's say me, I'm going to say, look, it's the property management company, sue them. But of course, they don't own anything, so you're going to get nothing. So that's kind of just one of the asset protection tools and ways of diverting liability. And
how well does that work?
It works as well, pretty probably, as anything else. It's all about, honestly, it's all about what you can argue and how strong you can argue it. The stronger you can argue it, the better it's going to work. Okay, business entity for agents. Okay, we're talking about business entities, and we're going to talk a lot about this tonight because that's kind of what the class is. We're going to talk about the different revenue streams in real estate. So in other words, how you make money in real estate, and the kind of business that you would use for that particular kind of revenue. Because there are differences, and a lot of real estate investors don't understand that. Okay? The business entity for agents, so we're still talking about real estate agents here, and making commissions, is an S-elected LLC. Okay, we're going to define what does this mean. The LLC is for protection. We talked about that, right? Agents do kind of fit in that gray area, and some things they do, they're kind of covered by their employer, and some things they do, they might be at risk themselves. It's not a lot. I'm not super concerned about liability in real estate agents. It's not. I don't lose sleep over it. You shouldn't lose sleep over it if you're an agent. Okay, especially as long as your broker maintains proper E&O insurance on you, then you're okay. Mostly, what we're talking about for real estate agents is this part, is the S election for tax savings. Okay, what is an S corp? Why do I have this down there? This, I probably have this conversation 2 times a week.
So
What's that?
So why?
Why?
No, so do I.
Oh, so do you, yes. S corp. And I just said it's an S-elected LLC. This is an S election. This is something you do with the IRS. Okay? The LLC is the actual business entity that you set up with the state. Formerly, many, many years ago, probably over 10 years ago, I think, you could not do an S election on an LLC. You could only do an S election on a corporation, an Inc. And so for a long time, these were known as S corps because they were corporations that had been elected to file under subchapter S of the tax code, a special section of the tax code that gives them tax benefits. And so they were called S corps, S corps, S corps, S corps because they were corporations. Then the IRS said, you know what? LLCs can't elect to be taxed under this same subchapter of the tax code. So we can now do an S election on an LLC. An LLC is a much easier company to run than a corporation. A corporation has to have shareholders, a board of directors, and officers, and more formalities. An LLC is much more flexible and it's much more easy to deal with. So these days, at least for the last 8 or 9 years, I will set up an LLC for my real estate agent clients and then do an S-election. Okay? So they're really S-elected LLCs, but everybody and their dog calls them an S-corp. Okay? Why? Taxes on real estate commissions are considered active income, also called ordinary income. This is income that you receive by doing work. Just like you got a wage, a salary from an employer. Okay? This is money that you earn by working. And as a real estate agent, you work to get your commissions. Okay? So even though you're paid 1099, okay, this money is really considered a wage, a salary. Okay? And as such, there are 3 taxes that apply. And a lot of my real estate agent clients don't really understand this. They know these 2. Everyone knows you pay a federal income tax and a state income tax. Okay? Everyone knows that dreaded income tax, that tax bracket, all of that. But this self-employment tax, or SE taxes, okay, this is the one that people don't necessarily know about and don't understand. And this actually comes off the top. This was actually first. Okay? What is self-employment tax? Okay? If you were an employee and you got a pay stub, okay? We're going to talk about pay stubs later tonight. Got both my accountant and and my payroll people are both here tonight. You remember those boxes and the withholdings? And there's the federal income tax withholding and the state income tax withholding, and then there's those other boxes, right? FICA, Medicare, Medicaid, Social Security. And you heard that your employer paid half and you paid half. Kind of remember that? Okay? That's the employment tax. That's the SE taxes that we're talking about here. But now that you're receiving 1099 income, nobody's taking that out. Nobody's withholding it. But you still have to pay it. And not only do you have to pay it, you have to pay your half and the employer's half, because you are both the employer and the employee. That tax is 15.3%? Yeah, there it is, right there. 15.3%. Okay? Social Security, up to $113,000. That's current for 2014, right? Yeah. Oh, I'm even missing a zero. But about $113,000. Okay, so up to $113,000, you can pay almost 12.5% to Social Security, and then almost 3% on everything. Okay? So after you make above this amount, this whole SE tax drops quite a bit. But you're still going to be paying that 3%. Okay? How does this work for numbers? Let's say as a real estate agent, you net $30,000 in 2014. Okay? You sold, let's say, $40,000. You made $40,000 in commissions, had $10,000 in marketing expenses and cell phone bills and whatnot. So you net $30,000. Your SE tax is $45.90. Okay? You're going to pay that right off the top. That's before you calculate your federal and state income taxes. Okay? If you netted $100,000, your SE tax is going to be $15,300. Again, that's right off the top and added on to your federal and state income taxes. Okay? So how do I reduce this? I can't help you with the federal income tax, and I can't help you with the state income tax. Can't do it. Sorry, there's only 2 things that are guaranteed in life: death and taxes. Okay? But we can reduce them, right? We can lower them as much as we can. So how do I reduce this SE tax? First, I can increase my business deductions. That's awesome, right? Deduct, 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 deduct. Expense, 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 expense. Okay? Lowers your overall tax burden, your taxable income. You can get it down to 0. Pay 0 self-employment tax. But for real estate investors, there's a big problem with that. What is it? What's that? Not that it look like a hobby. You don't make any money. You have no income. How are you going to get a mortgage for your next rental property? How are you going to finance something? Right? Real estate investors want to show income so that they can qualify for mortgages and buy more properties. So it's this double-edged sword. Either you make money and can get mortgages and invest in real estate and pay lots of taxes, or you make no money and pay no taxes, but then you can't invest in real estate. Well, you can, but you can't. It's much harder to get financing. Okay? So that's one way. The other way is to do an S-election with the IRS. Okay? That's why we talk about S-elected LLCs for real estate agents. What this S election does is it will divide up your income between this active income, which we're going to call wages, and dividends, which we're going to call passive income. So active versus passive income. Let's do this a little bit. Now let's go through another example. Here's our first example where our net was $30,000 and our self-employment tax was $45.90. The S election split. That's what I call it. Salary, dividend. Salary is a wage. Right, that's your active income. Everything used to be active. Okay, so this part is subject to that 15%. Okay, dividend is what you get. Essentially, it's a dividend or return on your stock for owning the company. So it's passive. You didn't do anything to earn that money. You got it by the mere fact that you own your company. Okay, so this dividend is not subject to the 15% tax. Okay, yes, it is still subject to federal and state income taxes, but not the SE tax. So let's say in this example, we call $20,000 our salary. That's what we paid ourselves for running the business. And we took $10,000 in dividends. Okay? Our self-employment tax went down to $3,060, and we just saved $1,500 by doing this S election. Let's say we make $100,000. We're going to call $40,000 salary, $60,000 dividend. Our self-employment tax went down to $6,100. We saved almost $10,000 in taxes. Yes, I know I know the question. Not you. Yeah.
That doesn't make a big deal that you're taking more with the dividend.
That's one good question. I'm going to combine. I think I'm going to combine questions because I talk this a lot. Trevor?
Is it always 2/3?
No. Okay. So the question is, and the question everybody asks is, how much do I split this up? Right? This we took 2/3 as salary and only 1/3 as dividend. Here we took 40% as salary and 60% as dividend. The IRS requires that you pay yourself a reasonable salary. Okay?
Can I mention?
Absolutely, because you're coming up here in a minute anyways.
Well, one comment to make about that is the IRS is really scrutinizing one owner S corps.
Mm-hmm.
They're saying, there's not a return on capital. Like there's no return on capital because if you weren't in that company making that company money, then there wouldn't be a company. So
Right.
if you have other employees and stuff, it's easier
To justify.
it. But they're coming right back and saying, what's the business for this S corp business purpose? Because it can't be just to save on tax. So real estate agents, it's a little bit tough for them. They just have to be really careful on what that reasonable salary is. If that makes sense.
So it has to be
Yeah.
enough to cover your expenses.
Yes, this is going to help justify things. We'll get to this in a minute.
Yeah.
Let's go back real quickly. So the split is whatever's reasonable. So people who think, well, I'm not going to pay myself any salary. I think I'm going to take it all as dividend. Eliminate that 50% altogether. Okay? No, you can't do it. So you must pay yourself a reasonable salary. No one has said, the IRS has not said what is reasonable. They're going to look at what industry are you in, what state are you in, because a real estate agent making commissions here in Utah is going to be very different than a real estate agent working in New York City. Okay? They'll look at what other people are making in your area, in your field. Okay? So it just has to be something, like I said before, it's what can you argue? It's all about what can you argue and justify.
Can I say one more?
Yes.
Sorry.
No. That's why I have you here.
My office has just been a couple audits on this.
Oh, good.
I did that. The other thing that they looked at your personal living expenses.
And yes.
So if they'll ask for your personal bank statements and whatever you use to spend, they think that needs to be your salary.
Yes. So if you pay yourself less than it costs you to live, then you have not paid yourself a reasonable salary because you haven't even paid yourself enough to live on.
Right.
But in a situation like where I'm at, where I receive W-2 income, but I also receive real estate income, I can probably take more of that.
It's whatever you can argue. Yeah, no, it's whatever you can logically and rationally argue to the IRS.
And I've seen an auditor do this, and I've seen an auditor do this.
Yeah.
So it's like, that's why they leave it open by saying reasonable salary.
Yeah, it's really, and everybody hates this. Lawyers all over the country hate this, and accountants hate it because, yeah, it leaves so much up to the particular auditor that you might get. So what do? You document things. You talk to your lawyer. You talk to a good accountant who knows what they're doing and who has a lot of clients in real estate, it's particularly real estate agents or making money through real estate, or a lot of clients with S-corps. Okay? It is absolutely paramount that you have a good accountant and a good lawyer and a good bookkeeper. Like I said, hiring others, bringing other people on board, even if they're independent contractors, the more you bring others involved in your company, the more legitimate you are. Because you just have a bigger case of evidence to submit to a court or to an IRS audit.
So if you have enough W-2 income to live on and you don't actually need anything from this business entity, can you do 100%
No.
dividend?
Still can't do 100%. Because somebody has to run that company. Someone has to be paid to run that company.
It can be lower if you're not taking any dividends, but.
Yeah, I mean, it's certainly an argument to why you, yeah, it's certainly an argument that you could take more dividends out of the S-corp because you don't need that salary to live on. But that's just another one argument in this big, complex set of arguments.
So at what point would you have to start paying this? If 90% of my income is from a W-2, and I've started to do all this other stuff,
Right.
When do you have to actually start, I guess, filing the SE part?
The SE part, I'll probably let Lee get that in a second. But you should start, as soon as you are classified as an S-corp. Very often, the first year people do it, I kind of let them be a little bit more flexible, and when they should always be paying quarterly taxes. Okay, you need to talk to a good accountant and say, okay, I need to pay quarterly taxes during the year. But usually I say within a year, if not preferably sooner, but sometimes when new agents or new business owners, they don't know exactly how much money they're making, et cetera. Within a year, I always recommend going on payroll. That's why my payroll guy's here tonight. Okay, because they'll take care of the salary part, and they'll pay you a salary and they deduct all the taxes for you, just like you were an employer. Okay, so yeah, it's just something you kind of got to grow with. Again, that's where you bring a team of professionals on board. That's kind of all the purpose of tonight's class is to build this team of professionals to help you in your business. So yes, pay yourself a real salary, build your body of evidence, have discussions with your lawyer, have discussions with your accountants, hold your meetings. You can, in meeting minutes, you can dictate, say, we have decided to issue this much in dividend and this much in salary for the following reasons, right? And record it and write it down and date it and sign it. Just show your thought processes. Just show that you acknowledge this and you were trying to make a determination of what was reasonable rather than just going, I'm going to pay myself this much and that much. Okay? So again, the more you document, the more you write it down, just the stronger case you're going to have.
So you have to decide this ahead of time?
Decide. No, you can. I mean, you can be flexible during the course of the year. Pay yourself more and more as the year goes on if you make more money.
A lot of real estate agents, they don't run payroll until they close. So.
Yeah, and you can run a payroll at any time, right?
Right.
There you go,
How
mate.
does this affect being able to qualify for a mortgage later on? Do you still get to claim the dividend and the...
That you're going to talk to a qualified mortgage broker like Matt Atkinson.
Okay.
Yes, not a lawyer. Want to qualify for a loan? Talk to Matt. Want to set up an entity? Talk to Jeff. Okay. Oh, yes, Mark.
Is it reasonable to pay yourself like so much an hour? You kind of keep track of how much you
Yeah,
do?
yeah. You can pay yourself an hourly too. At a reasonable hourly wage that you pay somebody else to do that work for you. That's a great logical, rational argument to say this is what I make. Because if I didn't do it, I have to pay someone $12 an hour to do it. Okay? Okay, so you reasonable salary, and you got to have the proper entity, whether it's a lawsuit or an IRS audit. Proper entity means you've got articles of organization, okay, filed correctly with the state. You have an operating agreement, okay. That operating agreement is the legal document of the company, and proper governance and records. That means meetings and more. Again, I teach a two and a half hour class on this. stuff. So we're not getting into details tonight, but just know that there are formalities that you must have to maintain this special tax election. Okay, great way to again, build your business is bring in outside professionals, okay? Bring in accountants, bookkeepers, payroll, legal counsel, assistants. Again, the more you bring in, the more legitimate you are. I have invited tonight Lee Johnson with Larson CPAs. She is actually my accountant. She does my taxes and she and Clyde have done my taxes for 7 years?
I don't know, I was gonna say 6. But
6?
Yeah, or 7.
6 or 7 years, okay? So she's going to come up and she's going to talk a little bit about the services she provides. She is fantastic. I've been with her for 6 or 7 years. I wouldn't be with her if she wasn't fantastic. I cannot tell you how important it is to have not only good, there's lots of good accountants, period. There's a lot of good accountants out there. That's fine. Get an accountant that has a lot of clients in real estate. Okay, we just talked about agents right now, but the rest of the next half of the class, we're going to talk about these other revenue sources that get a little crazy. And there's a lot of specifics on how they're taxed. And if your accountant isn't familiar with these kind of revenue streams, you may pay more in taxes than you should have or deducted things incorrectly. So Lee, if you want to come up, I'll give you the platform. So Lee Johnson from Larson CPAs? Larson and Company. Okay, great, thanks.
All right, we get to talk about taxes, which is always fun. I've been with Larson since 1997, so I've been there a long time. I have a lot of real estate clients, so I know this industry well, whether it be real estate commissions or whether it be like wholesaling, flipping, things like that. I have a lot of clients that do all of it. So one of the things I kind of wanted to piggyback off of Jeff was finding someone that you can work with kind of in a network of professionals. I really like when I have an attorney friend that when clients come to me that I can talk to the attorney, because then if they want to make a decision, they go, this is what I'm thinking, and I say, okay, this is what I think you should do. Let's talk with Jeff and see if that's good on his end and my end, and then we make an agreement and kind of come up with what is best for you overall. So regardless of who your team of professionals are, make sure you have a team so that you can do the best, because everybody's scenario is different. And so you need to make sure you have people backing you up, making sure that you're doing what you're supposed to be doing. So part I want to kind of piggybacking off of the S corporation talk, there is a lot. The IRS really doesn't like S corporations. They really scrutinize them. They really want to throw them out, because if they throw them out, you have to pay all that self-employment tax to them if they can throw it out. So there's a lot of things that you have to do in order to make sure that it's in order. And Jeff, handles the legal side, but we try to handle the other side, so that you don't get into trouble with reasonable compensation. What's your business purpose, things like that. And so that's kind of as far as what. I'm not sure what else I'm supposed to talk about. Do you guys have questions about specific types of income? Do you have? I don't know if we'll get into a whole lot later, but.
I think back to the split question. So if I'm not an S corp and I'm starting to diversify my income, at some point, when do I have to pay taxes? Would I just pay regular ordinary income taxes?
So do you have no S corporation?
No, I have
yeah,
LLCs.
It would just be ordinary income taxes.
Just be ordinary income, okay.
And so what happens is if you owe taxes in this year, the next year they want you to pay basically 100% of it in throughout the following year. So you'd be set up on quarterly installments. Now if you have your W-2 and your W-2 has some withholdings, those go into account as far as what your quarterly estimates would be. But you still have to pay those quarterly estimates regardless of if you have an S corp, an LLC, anything like that. So if you owe taxes, you have to pay it throughout the year. Yes.
So is it better to do it quarterly, or do you have to?
You don't have to, but you get penalized if you don't. So the first year that you owe taxes, you're fine. You don't have a penalty. But the next year, if you owe to the following year, they want it paid throughout the year. And if they don't, then they charge you a penalty, because the IRS wants their money throughout the year so they can earn interest on it. So, yes?
Just to clarify, it's only if you actually owe tax.
If you actually owe taxes on your tax return, yes.
My second question is, can you, and I don't remember much about this, but can you clarify for landlords how big you can get before your passive income has to go to active income? Isn't there some kind of
so there's a lot of different things with real estate, but passive to active is basically if you're spending over 500 hours a year on this specific project. But then you move into like, are you a real estate professional? And that's a whole other bunch of criteria. So there's a lot of different things. One of the things that happens a lot is, people have rental properties and they have losses, and so they write the losses off, but they can't write the losses off because there's criteria that makes it so they can't. So if you have a W-2 for over $150,000, you can't write off real estate losses. They just carry forward. So there's a lot of like little weird rules like that to real estate that you have to make sure you're following. And again, everybody's circumstance is a little bit different. So there's active passive rules, and then there's materially participating. There's a whole bunch of different terminology on each.
So let me ask a more specific
Okay.
question. So when the time comes when I can quit my full-time job and just live on my rental income, which I hope is really small.
So do you just do all long-term holds?
Yeah.
Is that what you have? Okay.
Anyway, when that time comes, I won't necessarily be any more of an active real estate professional than I am now. But I'm just wondering if I need to consider like weird, crazy changes to the taxes.
It's rental income though, right?
Yeah.
It would be not taxable to self-employment tax. It wouldn't matter how, if that's what you did all the time, the rental income itself wouldn't be taxable to self-employment tax.
And it doesn't matter how big
No.
how big or how
The rental income itself will not. Now, if you start doing other people's, if you start doing property management or something like that, then it switches the income. But rental income, now I don't know if you talk about this later, but there's the new net investment income tax this year. You heard about that? So rental income is subject to that tax, which is 3.8% once you reach over $250,000 if you're married.
That $250,000 gross income or $250,000 in the rent income?
It's gross income.
Gross
So it'd be
income.
overall, if your tax return has over 200 if you're single, 250 if you're married, of total income, then your net investment will be taxed at 3.8%. So and rental income will always be considered under net investment. So that's new 2013. So that's something. It won't change if you're active or passive, but if it's total gross income.
Total gross.
Yes.
So that's your W-2 and your
Yes,
1099.
all of it. In fact, it's you and your spouse combined. If all of it together is over 250, then you get that tax.
And what's it called?
Net investment income tax.
But that's just off of your Schedule E, right?
Yes.
So it's really after all of your deductions.
On rental
the
it is.
rental piece.
On the rental piece it is. As
Not
long
just
as
gross
it's,
rent.
yes. And then the other thing with rentals that's been a huge change for 2014 is the capitalization policy. And I don't know how many of you have heard of it, but it basically says that you have to have a capitalization policy in force in order to be able to deduct any repairs, anything on your property that's over $500 or under $500. So you can't anymore. You can't say, because it used to be that we would look at a rental property and we would say, oh, you bought this rehab and you're going to make a long-term hold, but there were no kitchen cabinets because the people tore them out when they left, and you just had to put them back in to be able to, put it to its value. Well, when you do that, you would be able to write that off. But now you can't do that anymore. So there's a lot of restrictions on making things be capitalized in order to stretch out the period of time that they're being written off. So that's new in 2014.
Okay. So that was anything under $500.
You have to set up a capitalization policy, or you can't even write off
And
anything that's in the first
How do
year.
you set that up?
It's just a little. I could send you a form, but it's just one sheet of paper, and it just says this is what I'm doing with my business, and then you're able to write off up to $500.
$500.
Only $500?
Only $500
In a
on
whole
a
year?
specific unit, a specific item. So it'd be $500 of repairs of this repair. You couldn't write off, like if you were to buy carpet, you couldn't write off the whole carpet. You would have to write off. You'd have to capitalize it.
So if you
Or
get a
or something
furnace,
like
Or
that.
furnace, if it's under well, right now, if you don't have a capitalization policy, you can't write off any of it, you'd have to, but if you bought it for $400 and you had the policy in place, you could write the $400 off.
That year,
That year.
rather than count.
Yep.
And
Okay.
that's starting tax year 2014.
2014. Yep, that's a brand new one.
So how's that different from like a depreciation schedule?
So when I'm saying writing it off all in 1 year, that would be you didn't depreciate it. So right now how it's standing is everything, January 14th, you have to depreciate everything. You have to take it all over the life of the asset. Unless you have the capitalization policy, then you can write off items if they're less than $500.
And does this policy have to be submitted someplace?
Nope, on file.
On file with the company.
Oh, okay.
On file of your company.
But it's a policy that's true of all of your holdings. You can't just cherry pick which ones you want to use that on.
No, it's on all.
Okay.
Yeah, you have to use the same policy on all of your properties. Yep.
How many of you learned something new about taxes today?
Not good, but.
Yeah.
Yeah, there's so much to.
Yeah, some of it's not good. But do you see how important it is to get an accountant who knows what you are doing, as opposed to an accountant that just is a good accountant? Yeah.
Do you?
I give Lee a big thumbs up, always. Seriously.
So just another clarified question. So are those capitalized expenses, are they amortized, depreciated over 27 and a half years, same as?
Depends on if it's an improvement or if it's just a, so, if it's carpet, we'll take it over more like 7 or 10 years. We can split out those types of things. You can't do your own sort of cost segregation study where you're like, I think that the electrical is this much. You can't do that. But you can break out items that are blatantly obvious, like a refrigerator, and those would depreciate over the life of that asset. So it just depends on what the asset is, to the length of it. Now, and then bonus depreciation went away, and then Section 179 went down to 25,000 from 500,000. So there's a lot of caps on that this year. So a bonus used to be if you had a fridge that you bought for 1,000, they'd let you take 50% of it in the first year, but now that went away. So.
What was 129?
The Section 179.
Or 179?
It was 500,000, and it's down to 25,000 now.
What is that?
It's when you can. It doesn't happen a lot in the real estate world, but it's if you bought a truck. If you bought a truck and you wanted to write the whole thing off in the first year, you wouldn't be able to. No. Well, you could
Unless it was cheaper than 25,000.
Yeah, unless it's cheaper than 25,000. But yeah, it would be something like that. It would be maximizing it all in the first year. So.
Did you know I don't worry about any of this? Do you know why? Yeah, she does.
He
It's her
shoots
job.
me an email.
I do all the time. Yeah, that's her job. That's her specialty.
One of
I'm the
other-
lawyer. She's the accountant.
Are we getting into like
That's the mortgage
bird
broker.
dogging, wholesaling?
We are,
flipping?
yes.
Do you want me to talk a little bit about that way that's taxed, or do
I will
talk about-
cover that, and then they can ask questions.
Okay, so
Yes.
I'll-
Yes, we will go
done?
each one of those line by line.
Okay.
Yes. Thanks, Lee.
Yep.
Okay. One of the things that Lee said was to get sort of this tax break in this S corp, and the IRS is really kind of picky about it, is you've got to set up the S corp not just to save on self-employment taxes, right? How do you do that? You build your business. One of the ways to do it is to protect your branding, or to just brand yourself. If you're a real estate agent, formerly the way this is the way I used to do it, is I'd have a real estate agent client, and we'd set up the S corp form, and I'd say, here you go, and they would just start, file the S election and get their tax break and go on their merry way. And really, that company just kind of hid. It was just kind of it just disappeared into a drawer. And their broker wrote the check to the LLC, and it went to the LLC's account, and their accountant did the split and all of that. But the entity itself did absolutely nothing. Okay. As the IRS gets heavier and heavier on auditing, especially these S corps, make sure you do something with that business. Use it as a business. Treat it like a business, right? Do all the things you're supposed to do as a business. One of those things is you can brand yourself and market yourself as that business. Deanna, do you have a brand that you use at all?
Your Facebook page or what?
No, I mean to brand your services. Is it just your name on a business card?
Yeah.
Okay. Highly recommend creating a brand about yourself. Right? It's also better for marketing. What's your LLC name? I love it.
Cool Pads, Utah.
Cool Pads, Utah. Love it. Okay? Yeah, it's a great brand. And if you take your S Corp for your real estate commissions, and then you turn it into a brand, and you have a website, and you do marketing through it, or you hire someone to do the marketing for you, these sort of things help legitimize you as a business. That you created this S Corp to run this business, not just to get the tax savings. Okay?
So does that name of your S Corp have to be like the name of your website, or just in there?
You can do a DBA and brand that DBA because your S Corp would own that DBA. Yes, and then use the DBA for your public persona. Yes, you can do that, but because it's the company that's doing it. Copyright, trademark, and social media. Copyright, you copyright things that would be considered artwork or art. Okay, a book, a painting, a photograph, a piece of music, or artwork that might be on your logo. Okay, these things can be copyrighted. Trademark is your brand name. Okay, Coca-Cola. Okay, that's the brand name. It is trademarked. Okay, the Coca-Cola bear, the white polar bear on their commercials, that image of that bear would be copyrighted. That's an artistic art. It's something that was created in an art department somewhere, and that would be copyrighted. Whereas the words Coca-Cola would be trademarked. You can trademark the name and an image, a logo, all in one, and you can copyright the logo also by itself. And if you are going to have a website and start doing this, then you really should do some research before you choose your name. Because you might get this great name, and you might get the company and the brand. You hire an artist to do your logo, and you spend thousands of dollars, and you find out that somebody in Georgia is doing the exact same thing. Okay? Now the internet is universal, so an internet website in Utah is an internet website in Georgia, and they can send you what's called a cease and desist letter and make you stop using that brand. Yes.
I had a client that happened to, and here they are, and they get everything. And they got it was from a company that was owned by Allstate. It's a subsidiary, and they basically sent it to them, and their attorney was basically said they got a lot more money than you, and so they had to start all over. And it was thousands and thousands.
Yeah, they put a lot of money into their branding.
So yeah, just taking that time to protect your brand, make sure you're okay to go with it, because you don't know what's going to happen.
Yeah, you can do Google searches. You can call me, and I'll happily do a trademark search to see if they've actually trademarked things. But if somebody's using it, even if they haven't trademarked it, if they're using it, they still have rights. So you still, if they're using it, you still need to be careful.
So having a unique LLC or S Corp name in the state of Utah is not sufficient?
It's not sufficient, no.
Okay.
As long if you go out, if you put that name out onto the web, then somebody could shut you down. They couldn't shut your LLC down. That's fine, because you're registered in the state of Utah. You're fine. You just couldn't use that publicly nationally.
Okay.
So what you'd end up doing, like his friend probably does, getting a DBA and changing the public face of your company.
What does DBA stand for?
Doing business as. It's kind of like an alternate name for your company.
So, real world examples, if you're a real estate agent and for some reason you choose to use a hot air balloon, RE/MAX is going to have a problem with it. And I've seen that. I used to be with RE/MAX. They will tell you to cease and desist.
I had a friend with the last name Kimball, and he actually got Kimball.com. This was like 5 years ago. A year later, Kimball Pianos said, "No, I'm sorry, we're not." He owned the URL. He had Kimball.com. He bought it. He owned it. They would not let him use it. And they said, "We got a whole lot more money than you do. If you want to fight this out, fine. But if you ever put that up, we're going to shut you down." So yes, Google search it, trademark search it, copyright search it. And I'm happy to help with that. Yeah.
Is there a time limit on your copyright or trademark?
Time limit mean how long it lasts? The term of the copyright and the trademark are different. Trademarks are generally less than 20 years. Or no, trademarks are generally can be forever. Excuse me. I'm thinking patents. I don't know why I must have been thinking about patents this week. Copyright currently is the life of the author plus 70. 70? Yeah, it's like a freaking long time, which is good. You know, my other legal life is actually as an entertainment lawyer. So I work with artists and musicians and filmmakers, and my job was to protect their copyrights. And I'm an author. I own copyrights on my books, so I filed for copyright. And of course, I want them to last forever, because then I capture all the money and I can keep people from stealing it. But with many things, at some point, things just kind of end up what's called the public domain. At some point, you know, it sort of becomes public goods. So it's always a battle of how long those last. Okay, I think 5-minute break. If you are a real estate agent, we'll keep this to just 5 minutes. If you're a real estate agent, go outside and see Ken. He will get you your certificate and a course evaluation that you kind of have to fill out. Okay, and then we'll come back.